drop base rally, which is also another demand zone. And I'm going to show you guys some real examples of how to properly identify and draw these zones. So rally base rally is the first one. It forms in uptrends. And when you're drawing demand or even supply zones, so when you're drawing any type of imbalance zones, you always have to look from the right to the left of the charts. And that's because you have to find fresh and unused levels where price has never been tested before. Now you're going to see that a little better once we get into the chart. But the reason why we look right to left is because we want to look at areas where price has never been traded before. Because if an imbalance or we're at a demand zone where there are unfilled orders sitting at, if price is traded there before, think about it, those unfilled orders are going to be weaker because there's going to be less of them. So we look for the areas where those orders are fresh and haven't been before, because that's where we're going to find the huge bulk portion of those orders just sitting there. So rally-based rallies create massive order imbalances, obviously, because it's a demand zone. And a rally-based rally is a bullish continuation pattern. So the idea here is you have to buy pullbacks into this imbalance, and you take your profits at supply and whatever supply we see above. So the main idea here is you have to buy the pullbacks into this imbalance. So because the market has rallied, based, and then rallied again, the market tends to pull back into the origin area of where the imbalance occurred, and that is because they pick up the rest of the orders for another leg higher. So if, let me see this. So what I mean by this is that the market rallies, bases, rallies again. So when the market pulls back down, we have that zone, and the reason why the market pulls back down is it comes back into this zone to fill the rest of those orders from the institutions for another move higher. Like I said, the institutions rarely do lose, and when they do lose, it's small. So we have to trade on their side. They have massive orders sitting in this green box. So what happens is price comes down, it attracts price lower. We come into this box, and their orders get filled because maybe the rest of their 50% or 70% of their orders haven't been filled from the first rally. So what happens is when price comes back down into this area, those 50%, 75%, whatever of those orders now are filled. And now they have their full position in this demand box, and now they move it for a leg higher and they take profits in supply up here. So it's just price comes back down into this demand zone to pick up more orders for another leg higher. So the market basing candle is the origin area of the demand zone since the price rallied, based, and then rallied again. So the basing period is a balanced area, and that's where the origin of the demand zone sits. So the basing area suggests there's a surplus of demand since price was able to rally out of the balanced area. Everything else on the chart is just noise, and the market is balanced where market participants are agreeing on price. So let me explain that really fast. Let me draw something up here. It's going to look a little messy. But let's say we do not know. It's not letting me draw. Okay, so let's say we don't know anything to the right of this rally zone. Anything from the right of where my cursor is, we don't know. So the market rallied, it based, and it somewhat rallied again a little bit. What caused this base, this red candle right here where my cursor is? What caused that base is that market participants are agreeing on a price, and that's why where the market is balanced. So buyers weren't in control and sellers weren't in control. There weren't a greater demand here, and there wasn't a greater supply here. So that's why we have a basing candle. So if it wasn't for the second rally up to the upside, this would not be a rally-based rally, and this would not constitute as a proper demand zone. So because we got this second move up and this rally up right here, that is what causes this basing candle to be a demand zone. So that means not every basing candle is a supply or a demand zone. You have to have a nice rally, base rally, and then the next candle structure is going to be a drop base rally. So you're going to see that, but the main point is that price comes back in, we get long in the green boxes, we get long at the pullbacks into demand, and we get long where these institutions have buy orders sitting for another leg higher. So we know it's demand because the market turned from balanced, which is the basing candle, like I just explained, to an imbalance, which is the rally up. We buy the sell-off, the retracement, or the pullback into this fresh area of demand, like I said. The large buy orders are waiting to be filled here. And what the good part about this is that retail traders are selling after a large drop in price into a level of demand. So we have this massive sell-off right here. Well, not massive, but a decent sell-off right here. And this sell-off is right into an area of demand. So retail is selling short, providing liquidity for more longs to get in right here, because for every buy order, there has to be a sell order. So big money is on the other side of the trade, buying at the demand while retail is selling. And it's important to identify fresh, untested levels where price has never been before, since they will have the highest probability of a strong reaction because they're going to be more buy orders waiting to be filled at that fresh area. Again, here's another example. So we have somewhat of a base down here, right? But we rallied from here. We gapped up. So that gap up is a rally because obviously there's an imbalance. Price rallied up. Then look at these two candles right here. It is a nice basing area. This is a 4-hour chart. So these two candles represent 1 day. In a single day, we based out after a nice rally. So this, if we move up and get the second rally to the upside, this is going to constitute as a demand zone. So now we know what happened on the second rally. It did rally up, price moved higher. This is a valid basing demand zone. We draw a rectangular box that represents a demand zone, and we wait for price to come into this area, and we can get long after we see a reaction from buyers in this area. And like I said on demand zones also from the last chapter, it goes from the top of the body of the red candle to the bottom of the wick. This is the same chart. We have the rally, we have the base, we have the second rally. Now look what happens. A massive sell-off, right? A nice falling wedge pattern into demand. Retail is selling in this area where my cursor's at. Retail is selling. They're bearish. They're selling into an area where there's buy orders sitting at from institutions. They're selling at an area where massive order imbalance to the demand side is sitting at. What happens when price breaks out of this wedge? We bounce at demand, break out of this wedge, constitutes as a valid long trade. We take it long here, put our stop loss below the box, and we have a nice upside potential. Next trade, rally, based right here, right? 1 day, 2 days. Actually, no, this is a weekly chart. So every candle here represents 1 week. We rallied, and then in a 2-week period, we held in a tight range. Tight ranges mean it's balanced. Balanced means buyers and sellers are agreeing on a price. So as long as we get the rally following the base, that constitutes as a valid demand zone. Rally, base, rally. Now we wait for price to come back in, retest the zone, and we take a trade if there's a reaction there. Look what happens. A year later, price comes into this demand zone. We bounce perfectly, and we go from 290 to 446. Straight from this rally, base, rally, demand zone. The second type of candlestick formation that we look for is a drop, base, rally. And again, it creates a massive order imbalance. It's a bullish continuation pattern. We buy in the imbalance, and we take profits at supply. The market has dropped, then based, and then rallied again. The market tends to pull back into the origin area of where the imbalance occurred to pick up the rest of the orders for a move higher. It's the same thing here, just like rally, base, rally, but we draw a different type of candlestick formation to identify these zones. So we have a drop in price, then we have a basing in price. Now this is a weekly chart as well, so every candle represents a week. We dropped, we based. We find the basing candle after a nice rally up. So if we didn't get a rally to the upside from this basing candle and price maybe moved down, this would not be a demand zone. But because of the second rally, we had a qualified demand zone from this basing candle right here. Draw from the top of the body to the bottom of the wick. Extend that. Price came down. Like I said, retail is chasing, short. We are buying in demand while others are selling and while others are bearish. You buy here, and this is a weekly chart. So this is 1, 2, 3, 4, 5 week rally from 320 all the way to 380. Now this is why it's important for you to understand the concept of fresh levels and areas that are untested. Like I said, areas that are fresh and untested will have the highest probability of working out because there will be more buy orders sitting there. So we have our demand zone. Look what happens the first time we tested this level. We had a nice reaction. Now look at the second time. Like I said, the second time, the third time, the fourth time, the more times you test the level, the less probability of it working out. That's because there's going to be less buy orders sitting there because the prior time filled those orders. So the second time we tested this area, look what happened. We did not hold this demand zone. So it's a less of a probability of it working out because more buy orders were taken out from the first move down into the demand zone. So it's important to trade really the quality demand zones and the quality supply zones, because if you don't, you're going to have a less chance of it working out. Here's another drop base rally. Price drops, base is out. We find that red candle before that base out. Draw from top of the body to the bottom of the wick. Next move is a rally. Now, we sit patient. We don't trade in this noise right here. We don't trade here because we have to wait for price to come back into this green box and bounce off of our basing demand. Look what happens on a Sunday night in the E-mini, S&P 500, open up in this basing candle in this demand zone, and price rallies from 24.50 to 26.25 without any pullbacks. So now we have supply zones, and supply zones are drawn the same way as demand zones, just flipped. It's just the opposite of demand zones, but we're talking about supply, so we want to see everything from the upside, followed by a strong move to the downside, right? So same thing as demand, we're looking to the left of the chart if we're talking about today. We want to find if price is coming into a supply zone, we're going to look at the left of the chart. We then want to identify a basing candle followed by a strong move to the downside, right? So we have a basing candle here and we have a strong move to the downside. So this qualifies as a supply zone. The zone now, this is different. This is how it's different from a demand zone. The zone starts from the bottom of the body of the basing candle. So the bottom of the body is going to be right here to the top of the wick if we do have any wick. Right? So that's our supply zone. We only trade after and if price returns to this zone, right? So once we see price now coming up to this zone, as you guys can see here, we will then look to buy puts or sell short and put our stop loss somewhere in this area above the supply zone, right? Because price now possibly can reject and come to the downside because we have a supply imbalance from the past. So, just like everything else, we're looking to the left of the chart from wherever the current price is, right? We want to identify a basing candle followed by a strong move to the downside. So we have a basing candle right here, followed by a nice, solid, strong move to the downside. This qualifies as a supply zone, right? So we draw from the bottom of the body of the basing candle, bottom of the body, to the top of the wick if we have any wick, right? That's going to be our zone, and we only trade after if price returns to this zone, and this is when we'll find our low risk, high reward trading setups. As you guys can see, this is the same chart. Look what happens when price entered this zone. We get our first rejection, some unfilled orders get filled here, right? Then the same day, we get another rejection from the supply zone, and look how strong and violent this move is to the downside, right? This is just from a supply imbalance. This is just from a supply and demand equation becoming so skewed, and the unfilled orders are getting filled by some people that are chasing and buying the stock, right? So here's another supply zone. We get a nice basing candle here, followed by a nice strong move, this nice strong red candle to the downside. So this qualifies as supply. As you guys can see, price rejected the supply. Even though we're in this zone multiple times, I still look for an entry because it's such a tight zone. So I'll still look for an entry here, right? My risk is very minimal for possibly a high reward, right? So I'll still look to enter this zone once I see a rejection. What's important is to notice is you want to look at a rejection from a smaller time frame. So this is a 4-hour chart we're looking at, right? I will qualify this as a 4-hour zone, but for me to enter the trade, I'm looking for a rejection of this zone on maybe a 5-minute or a 15-minute chart, right? I don't just enter a supply or demand zone once the stock reaches the zone. I wait for a rejection. I wait for confirmation, and I wait for a candle rejection, or maybe I wait for some level 2 action or time and sales action, and I see sellers are stepping in, or I see buyers are stepping in for a supply or demand zone, right? So I want to maybe see a lot of sell orders here, or maybe I want to see a lot of buy orders if I'm looking for a demand zone. And you could tell that by the time and sales. So I don't just hop in right away. That's important for you guys to understand for both supply and demand. I wait, I look for a smaller time frame confirmation. I enter and I put my stop loss right above the zone. So same thing as demand zones. This can form from any time frame. You just need a consolidation basing candle followed by a strong and violent move to the downside. We're talking about supply, so we're talking about a downside move. We're selling in supply. Always start with a higher time frame and you move down to the smaller ones. Like I said, you could start with a monthly or weekly, then work your way to dailies, then 4-hour chart, then a 2-hour, 1 hour, 30-minute, 15-minute, 5-minute. You can still find supply and demand on a 5 or 15-minute chart, but I use the 5 and 15-minute charts for confirmation, candlestick rejections in a supply or demand zone, then I enter the trade. Once I get that confirmation from a smaller time frame chart, I enter and put my stop loss right above the zone. So doesn't matter how long in the past the zone has been sitting there. All that matters is if we have a fresh zone with a lot of unfilled orders, because that's when we'll have the high probability trades. I wait for the stock to reach that zone, and once it reaches that zone, we'll be in an imbalanced period, and I'll sell short. I'll buy puts accordingly, right? You'll get used up zones will be less probability. There'll be lower probability trades because the more orders it will fill, and the greater the chance the zone will break and will not work. So here's another example of a supply zone, and here's Amazon. We get a nice consolidation candle here, followed by a nice violent move to the downside. So I draw the zone from the bottom of the basing candle to the top of the wick, follow along. I wait for price to then reach this zone sometime in the future, and as you guys can see, price reaches this zone. We get a solid rejection and we get a nice move to the downside, solely from the supply equation being imbalanced right here, right? Here's another example. Now this is a 15-minute supply zone, so we get a nice drop, then we get a basing candle right here, followed by another nice drop. So I draw the zone from the bottom of the basing candle, the bottom of the body, to the top of the wick, and as you guys can see, price then rejected right here. We get nice 3 candles on a 15-minute chart, solid rejection because you guys can see the wicks rejecting this zone, right? So this is what I would look for on an intraday basis if I want to take the trade. I'll wait for these wicks to reject. I like to see a lot of upper wicks. Then I'll maybe get an entry, right here somewhere and put my stop loss right above the box. But this is what I mean when you want to use a smaller time frame chart to get and qualify entries based off these supply or demand zones. So here's Amazon on a daily chart. We get a nice basing candle followed by a nice violent move down, draw the zone. I look to the right and look what happens when price enters this supplies imbalance, right? It's very simple, guys. It doesn't have to be complicated, but you want to make sure you guys are qualifying for the right zones. You guys don't want to just plot zones and take the trades off zones that aren't valid. You want to make sure they're valid. And the only way to validate and confirm these zones is only if we get a basing candle followed by a nice strong move to the downside, right? So here's another candlestick and a chart pattern that I look for, but this is for supply zones. It's the same thing as the rally base rally, but it's for the downside and supply zones. It's called the drop base drop, DBD. We get a drop downwards, right? Then we base out. Then we get another drop downward again. It's a bearish momentum pattern. So what happens is price pushes down and it creates a short balanced period, right? You guys remember the balanced period is when we base out. So we get a balanced period. And during this basing out balanced period, I do not trade here because this is where institutions are leveraging in their positions, and then we get our second drop down. So the only way this qualifies as a supply zone is because we get this second drop down. If price then started to move back up, let's say right here, right, and we didn't get this second drop, this would qualify as a demand zone because now we move up strong and violent to the upside. So the only reason why this qualifies as a supply zone is because we get this second drop to the downside. So basing period is where the institutions collect orders to fuel the next drop. Two ways you can play this. Same thing as the rally base rally. You can get this. You can sell short, buy puts at the break of this base to the downside, put your stop loss at the above it, or you can wait for price to come up, hit the supply zone, reject it, and come back down and make money and profit for the ride down, right? So here's Tesla. Here's a drop, right? So we get a drop here, we get a base here, and we get another drop at this candle. This qualifies as a supply zone. We wait for price to re-enter this zone. I do not trade until price reaches an imbalanced period. It's important to never trade, or if you follow this system, to never trade in balanced periods where price is in the white space, or price in this case is in the dark space, because you don't want to trade during balanced periods. I only trade where these imbalances occur. That's when I'll get my best entries. So as you guys can see, we have another drop here, we base here, and we drop again here, right? So this is a drop, base, drop. We have two drop, base, drops next to each other. Here's our basing candle followed by another drop. So we draw at the bottom of this body to the top of the wick. We wait for price to come. You guys can see we hit it here, we come down accordingly. We hit it here, we come down accordingly, right? It's very simple, guys. Please do not overcomplicate the process. Another example, right? We have a basing candle followed by a shot down before the close. Then we open up and close down even more, right? I draw this zone. Look what happens when price reaches this zone. It's more towards the end of the day, right? So look, they close it in a supply zone. You have people, you have retail traders buying it, maybe swing trading it, holding it into tomorrow for possibly a gap up. If you know there's a supply zone here, I would never hold this overnight. I'd be looking to sell this thing short overnight or buying puts. We close in a supply. Look what happens the next day. We have bad news or something and we gap down, right? So that's another trick they do is they close stocks sometimes in a supply zone, or they'll close them in a demand zone and they'll gap them up, right? Or gap them down. What they do is they trick these retail traders in buying before the close. They make it look good. We rally into the close. Retail's buying, right? Providing them liquidity for their sell orders. And look what happens. They release news the next day. We have a nice gap down, right? It's just the trick institutions play. So knowing where these zones are will protect you guys, and knowing where these zones are will make you guys profit, right? It's very simple. Please do not overcomplicate this at all. So just like the last chapter on supply zones, we also have two specific candle structures that I look for when I'm drawing up supply zones. Now the first is a drop base drop, which you guys have seen in the last chapter. So drop base drops, and then we have rallies, bases, drops. And I'm going to get into that a little later in this chapter. But first, drop base drop. It forms on downtrends. It's a bearish continuation pattern. And the idea here is to sell on the bounce into the supply. So the market drops, it bases, and then drops again. The second drop confirms that there's a supply imbalance at the basing candle. We draw them at the basing candle, remember. So we look to sell, to start new positions. So to sell short, you short sell on the bounce into supply, putting your stop loss above the supply zone. We wait for the market to rally into the imbalance, and we can take it short for a high probability setup and proper risk above the zone. Now, drop base drops look like this. You have a nice drop in price from this red candle. Then you have a basing candle followed by another drop. So majority of drop base drops look like this, where the body of the basing candle is inside almost like a hot dog. It's sandwiched in between the two candles. So the basing candle, from the bottom of the body to the top of the wick, we draw our zone and we extend that and we wait for price to enter that zone sometime in the future. And like this happened, 4 hour supply. This is a 4 hour chart. We tagged it and we moved down from 214 all the way down to 200 almost. So this pattern right here is what we look for in drop base drops. It's sort of a sandwich type looking, but you have a nice drop from a nice strong red candle down, followed by a base, followed by a nice strong drop down from another huge red bodied candle. So here's another drop base drop. We dropped this day. This is another 4 hour chart. Dropped, based from this green candle, dropped again the next morning. This right here created a huge supply imbalance. There's massive supply up here. There are massive sell orders just waiting to be filled here. So we wait for price, like always, to come back into the zone, retest it, and we can take this trade for a high probability short setup. So we wait for the drop to form, then we wait for the bounce. Now the bounce could happen tomorrow, the bounce could happen in a year from now. We wait for that bounce, a rally in price into supply, and we take that short. So drop base drop. Let's go back to it. Now we have rally base drops. Now this is new. This is the second candlestick structure that I'm looking for. Rally base drops also form on downtrends, but what's important here is that it's a bearish reversal pattern. So if we're in long positions, we look for rally base drops to sell into, to take profit into. So we're looking to sell after a rally into the supply. You can also take this short, but I look for rally base rallies to take profits at, and I also will look to take short, but I have to be cautious with taking short here because the overall trend might not be in our favor. So what rally base rallies is it the market rallies obviously, and then it bases, then it drops again, which creates a massive supply imbalance after the basing period. So there's a surplus of sell orders waiting to be filled at that area, and it's a high probability to scalp short from or take profits if long before. So if I'm finding rally base drops, I'm looking to scalp short. I'm not looking for trend changes here. I'm looking for scalp shorts, and I'm going to show you why. So we have a rally. So this whole day, this is the E-mini hour chart. We had a rally. Then we based out up here, and then we look for that drop. And here's the drop. So this basing candle right here, again, it's also looks a little sandwiched. It looks like it's in between a hot dog bun. But we based here, draw from the bottom of the green candle, the bottom of the body, to the top of the wick, extend that, and we wait for price to re-enter that zone. Now, this is an hour chart, so you don't see what happened in this huge candle right here where my cursor's at. If you go down to a smaller time frame, you would see the rejection. So you're seeing this long upper wick only because we're on an hourly chart. But if you go to a 5, 15 minute, etc., anything smaller, you'll see the nice rejection. So this is important because it's a rallied. We based, then we dropped again. So this right here is our supply zone. Now the reason why I look to scalp short is because most of the time we rallied the day before, so some bulls are interested in this area. Then we based and then we dropped, which formed the trend to come down. So now we're in a downtrend here. So what happens is if price comes back up to here, I'll look to scalp short. Because of this rally, there's potential for us to break this base easily and continue to go higher. So this is not a full bearish position, a full bearish supply zone. This is just a good area for us to either scalp short. So we can take it short, but just look for a scalp or go smaller size, and because you have to be a little cautious. Or if we're in a long position, we can take profits up here. I just am a little cautious with rally-based rallies. Now this is also going to depend on every person's risk. As I've mentioned before, it depends on every person's risk because some people could hold on to this, but you just have to be careful for a bounce after a rally-based drop and we reject the supply. Just be careful after we scalp this for a potential bounce and for a potential to us to retest the zone and possibly break above it. I'm not counting out shorts with rally base drops. I'm just either scalping or going with smaller size to protect myself a little bit. So again, we have a rally, we have a base. Look where the trend starts to change. It starts to change at the basing period because of this drop we got followed by it. So bottom of the body of the green candle to the top of the wick, we extend the hourly supply zone and we tag it right here. Rallied, based, dropped. Quality, rally, base, drop, supply zone up here. We have an hour chart. So the next chart I'm going to show you is going to be a little smaller time frame. So this is why you have to go into smaller time frames. And I have a video on this later in the course, but you have to go into smaller time frames to take the trades. If we were to take this off an hourly chart, you wouldn't have really seen the rejection. You would have not seen the high or low. You really would have not got confirmation. That's why it's important for us to scalp rally base drops, because look what happened after this rejection. The next 1 hour, 2 hours, 3 hours, we came up, we held value in supply, we extended this over, and eventually we took the supply over and moved higher. So that's why it's important to scalp this, to get a couple points, take your profits, and call it a day from there. So the next chart is going to be the same exact chart, just on a 15-minute time frame, which is going to show you the rejection. Again, this is an hourly supply zone, so we're looking at a 15-minute chart, and you're not going to see the candlestick formation. That's why you have to work your way down from supply zones. You have to start at a weekly, then go down to the daily, then go down to a 4-hour, 3-hour, 2-hour, 1 hour, then go down to a 30, 15-minute, 5. So work your way down, because if we charted this 15-minute chart right here, you wouldn't have seen this 1 hour supply zone. But if you go on an hourly supply zone, you see a perfect rally base drop formation. So again, rally base drop. When we come into the supply zone, look what happens. We rally. Look at this green candle right here at the top. That's a basing candle followed by a drop. This is a supply zone on a 15-minute chart inside the supply we were looking to scalp short at, the 1 hour zone. That is confirmation to get short right there. So you could have took this short once we rejected this, formed a lower high, took this short, and could have grabbed a nice 50-point move down on the E-mini, which would have been about $1 on SPY, or about 50 cents on SPY. And that would have been a good trade. If you traded the options, if you traded the futures, that would have been a good trade. But this hourly supply off of a rally base drop is important to scalp off of it, because now if you look on the next chart, we broke past the supply, we tested it, and we broke above it. Okay, I wanted to make a video on how do we trade off these supply and demand zones. Do we just hop in automatically when a stock comes to the zone? Do we wait? Do we need confirmation? Could it be a set and forget type of play? Meaning, could we put an order out there already and we wait for it to execute? We put a buy order, we put a sell order, and we put a stop loss order. Could we trade that way? So in this video, I'm going to clarify, hopefully, a lot of the questions that I've been getting in the chat room on how do we trade based off these zones. So the first thing I want to mention is that you shouldn't just trade when a stock reaches the zone. So in this example right here, we have the S&P future. We have a nice 2-hour supply zone that we reached the following day, right? And as you guys can see, price entered this zone briefly and automatically rejected it. So we have some sort of confirmation there. We don't want to hop in a stock if it's in a demand or supply zone if it only reaches the box and it doesn't act as an important level. And what I mean by that is a lot of times that these stocks or the futures, that whatever instrument you're trading, they come into the supply or demand zones, and sometimes they won't react as if they're a supply or demand zone. Now that's because if something reaches a zone, there could be more buyers than sellers, or there could be more sellers than buyers, depending on if you're talking about a supply or demand zone. So what I mean by that is, if a stock, let's say in this case, the S&P comes up to the supply zone, right? But we have enough buy orders and the stock just shoots right past this supply zone. It continues to head up and up and up towards 30.50, right? That would cause that these unfilled orders sitting at this level aren't enough for them to take over, meaning the buyers are taking over the sellers in this supply zone, obviously. But in this case, the supply zone worked, and there was more sellers, there were more unfilled orders than there was buyers or buying orders at this moment. So we need to find confirmation. And what I mean by confirmation is you don't want to just hop in right away. So this is a 2-hour zone, right? You guys can see the formation right here. We have a nice basing candle. We draw it up to the wick and we follow it, and we wait for price to reach that level sometime again in the future. And this happens to be the following day. So now I'm going to show you guys a little smaller time frame and what it looks like, right? So now we have the same 2-hour zone, obviously, and now we have one candle in there rejecting it, and then we have another small consolidation base candle here. This could have qualified easily for a supply zone, right? Even on the 2-hour chart, this could have qualified for another supply zone. So here we have an hour chart. We wait for price to reach this level, and we could short it once we see this wick here. This wick is rejecting on an hourly chart, right? Or what you can do is go to even a smaller time frame and wait for a rejection. Now this is a 30-minute time frame. So now we rejected on this 30-minute candle. We came down, we consolidated, and boom, price falls, and it falls very hard. Matter of fact, you could even go down to a 15-minute time frame and see how we rejected the supply zone. So now we have two candles in the supply zone that rejected versus the 2-hour zone or even the 1-hour zone. So I'm going to go to the 15-minute chart again, right? So we reject, then look how hard we rejected this one candle right here, right? We have a huge, almost engulfing red candle down, followed by consolidation, followed by another strong move to the downside. So what I'm trying to get in here is that you shouldn't just hop in, because I'm going to show you guys an example of why you shouldn't just hop in. I'm just telling you guys that right now. But you shouldn't just hop in once price reaches a supply or demand zone. You have to wait for confirmation. You have to wait for a rejection or a bounce off that level. And obviously we have a rejection. You guys see this strong candle sell-off right here. And we have other supply zone formations in the supply zone, as you guys can see. So we need confirmation. We can't just blindly hop in to a play. And you guys are going to see why confirmation is important and why we shouldn't just buy or sell something because we're in a demand or a supply zone. So here's a good picture of Netflix and another 2-hour demand zone, right? So you guys would see why this 2-hour demand formed right here. So now we move this box over and we wait for price to re-enter that level. And in this case, it also happened to happen the following day. So if we were to use this 2-hour demand zone and look on a 2-hour time frame, we're just going to see one red candle straight down followed by another green candle up, right? I don't want to trade this 2-hour supply zone from a 2-hour chart. Even though I plotted it on a 2-hour chart, I don't want to make a trade. I don't want to enter the next day on a 2-hour chart because you're just going to see a bunch of mess, right? I want to go down into a smaller time frame, maybe an hourly, right? So if we were to look at this 2-hour demand zone and we were to look at, let me just draw something here. If we were to look at the first two candles, we don't know what happens here, right? We don't know what's happening right here. Would this look like it's going to bounce within the first two candles? Was there ever a bounce on Friday within the first two candles? No. This would look terrible if you didn't know what happened afterward, right? This doesn't look like the stock's going to bounce. This looks like the stock's going to completely avoid the demand zone and fall even further down, right? So I'm going to remove this now. And as you guys can see, yes, we did come below the demand zone, and this wouldn't have qualified for a solid supply-demand trade, right? So that's why it's important for us to not hop in, let's say buy right here, right? And put our stop loss down here. We want to wait for something to maybe react or bounce off this level first, then enter, right? Then enter maybe somewhere here and put our stop loss at the lows. But obviously this came below the demand zone. So if you were to trade based off of the rules of only trading in a supply zone, this wouldn't qualify it. And this wouldn't be a trade I personally would take because it came out of this demand zone. But as you guys can see, you guys can trade around these zones because look what happened. A 1 hour demand formed right here. So now we have going into Monday and going into the weekend, we're going to have a demand zone that formed here. So now what I'll do is I'll wait for price to come in into this zone and then wait for a possible bounce for a move up, right? So we even go even smaller now and we have a 30-minute chart. So I'm going to, again, block everything out, act like we don't know what happens next. We don't know what happens next, right? So now we have this 2-hour demand zone. Look what happens. The first two candles are red, doesn't look good, but look, oh, we have a green candle and we have a basing green candle. Am I going to hop in this play long because maybe it looks like we're done selling off and this demand zone is going to be a valid zone? No, I'm not going to hop in, right? Just because we have a green candle here doesn't mean I'm going to hop in. You need confirmation. Look what happens if you got in at this green candle right here, right? And put your stop loss below the box. Look what would have happened. You would have got stopped out, right? You want to wait for confirmation. And what I mean by this is you want to look for maybe a candlestick formation or a demand or a supply zone forming, or you want to look for higher highs. So if we saw a candle, right, and we closed up here, this doesn't exist down here. We closed up, and look, we can maybe start forming an uptrend, right? So you want to look for confirmation, maybe a higher high for a demand or a lower low for supply. And I'm going to show you guys that in a minute. But I just want to stress the point that you need that confirmation. You can't just hop in because we're in that zone, right? So you want to look at different time frames. You want to look for confirmation. What's going to serve as confirmation? Higher highs, lower lows if you're talking about supply, or long wicks. Once you have a long wick, that means buyers or sellers are stepping in, and that'll help confirm price. But you just want to make sure you have that higher high, lower low, longer wick. Or you could use a technical pattern or a candlestick pattern, such as a double top or a double bottom, right? So what I mean by looking at different time frames is if you're trading a 2-hour supply zone, don't look at a 4-hour zone or a 4-hour chart and see if it's making higher highs or lower lows. Why would it make sense if you're looking at a 2-hour zone to look at a 4-hour zone for confirmation, right? Or if you're looking, let's say, at a 15-minute demand, don't look at the hourly chart to confirm if you're bouncing or not. If you're looking at a 15-minute demand, you want to look at either a 15-minute candle chart or you want to look at maybe something like a 5-minute candle chart to get confirmation, to get those higher highs or lower lows. You don't want to look for, if you're looking at a 15-minute demand bounce, you don't want to look at an hourly chart to confirm making higher highs, because then you're just going to get in the play too late and the move that you're expecting might have already happened and you're going to miss out on a good portion of profits. So the rule is for larger time frames, you want to move down into smaller time frames to confirm. Now, you don't want to go too crazy. You don't want to be looking at a daily chart and do a confirmation on a 15-minute chart, right? You don't want to be looking at a 4-hour chart and look at a 1-minute for confirmation. You don't want that. You want to use something that looks like it's going to potentially bounce. And how you can tell by that is higher highs. Or if you want to look at something rejecting supply, you want to look for lower lows. That will give you confirmation. Once you get that lower low or the higher high, you could enter a call or a put and then put your stop loss above or below. Right? It's very simple, but I don't want you guys getting in too early. That's what I've seen a lot of you guys do, is you get in just because stock is in a zone. That's not the proper way to trade. You want to see that zone confirm. You want to see that zone act as an important key level, as an important supply or demand level. So here's Tesla, and here's a 1-hour demand zone. So you guys can see, we make a nice move up. We base out right here, then we follow by another rally to the upside. So this is a demand zone. We draw from the top of the body to the bottom of the wick, and we follow and we wait to enter until price reaches that level again, and we're in demand, so we want price to bounce. We want to see that higher high. So if we were to trade off the hourly zone, this is what I mean. you might get in too late, right? So if we were to confirm off higher highs, we would get in somewhere right here with our stop loss either at the lows or a stop loss at the bottom of the zone, depending on your risk tolerance. Now, this is going to be different for everybody because everybody can risk more. Everybody's going to be able to risk a different amount of money than somebody else. So it's going to be different for everyone's risk tolerance. Some might have a stop right here. Some might have a stop at the bottom of the box. And hey, some might have a stop over here at this other demand zone, right? So if we were to get in and follow this hourly chart, we would get in over here. It would be a late entry and we're missing out on this portion of the move right here, right? You guys following along with that? So this is what I mean by going into a smaller time frame. And you want to wait for price to bounce. You want to wait for that higher high and you want to wait for price to react off that zone. We're only going to get a strong move up if we react off this demand zone. So if we were to look at this again without seeing the future, we would see prices downtrending, right? So that's reason number one to not hop in calls. But some of you are like, we're in demand. I'm going to hop in calls because it's known to bounce here. That's totally okay. But I want to wait for confirmation. That's just the way I trade. So this doesn't look good for a bounce here. This doesn't look good for a long position. This doesn't look good to buy calls down here, right? But if you were to go to a smaller time frame, let's say a 30-minute chart, look what happens. We come down, right? But look, we're basing out right here, right? So we could have another demand here. And we get a nice bounce, a higher high, and we make a nice strong move to the upside, right? This is on a 30-minute chart compared to a 1-hour demand zone. Now we could go even smaller, let's say, to a 15-minute chart on a 1-hour demand zone. And look what happens, right? We're coming down still, but look, it looks like we're basing out, right? We're starting to get flatter and flatter and flatter, even though we're in a downtrend. This is where the orders are getting filled, right? This is where institutions could possibly even be leveraging in for another position. But all these unfilled orders from back here are getting filled. And look what happens. We make the higher high. Now, if you go to this 15-minute chart, right, you're going to see things differently than what you do on the hourly chart. So now your entry is going to be even lower than where you would have been if you were looking on an hourly chart. We're even lower, which means our reward's going to be higher and our risk is going to be lower, which is something that everybody should be looking for. Lower risk and higher reward, right? So that's why it's important to look at those smaller time frames. And you could go even smaller now to a 5-minute and look what happens. We're going down, right? But we're basing down even though we're going down. And this is what I mean by a technical pattern, right? We have a bottom here followed by another double bottom. So we technically double bottomed here, right? Remember what I said in the beginner's course is that we don't need to come down to the exact price to double bottom. All we need to do is come to the body of that first bottom. And as you guys can see, we easily came down and double bottomed here, right? So that's even another confirmation. You could enter maybe somewhere over here, put your stop loss down here from this low or possibly this low, depending on your risk tolerance. So here's a crude oil trade, right? We have a weekly, so now we're even longer term. This is a weekly supply. And as you guys can see, right here's the basing period. All the way we wait for price to come. And look what happens. We reject this weekly supply. And now I'm looking at a daily chart here right now. So I'm not going to look at a 15-minute chart if we have a weekly demand zone or a weekly supply zone, excuse me. So this is a weekly supply. Would it make sense to look at a 5-minute chart or a 15-minute chart for confirmation? No. Here's the same zone, just zoomed into an intraday look. We have a Monday, a Tuesday, a Wednesday, a Thursday, right? If I look at a 15-minute chart, I don't see no rejection off this level. I wouldn't think this is a strong supply level, right? Look, we come straight up this day. It looks bullish this day, even though we're in supply, right? But I'm looking at a weekly supply, so I don't want to be looking at this smaller time frame. I want to go on something a little smaller than that weekly, maybe a daily chart, right? So if we were to go on the daily, look what happens. We have this day that I showed you before, which rallies up, right? So this green candle there is the day that we rallied, which would be this day. we're in supply. It doesn't look like it's gonna be a good short position, does it? No. But if we were to look at the daily, here it does, right? Look at the next day. We have a nice inside candle, a nice even smaller day, smaller of a range day, and then followed by a break of this lower low. And look what happens to price. We come down $4 within the next maybe week and a half, right? So this is why you want to follow confirmation. If I was to be looking at this 15-minute chart or even a 30-minute chart, I would not want to short this, right? It's safe to say that, right? But if we were looking at this daily chart, I'd want to short this day right here, right? This day right here, this supply zone confirms, and it's going to be a valid trade. So you just want to have that confirmation, as I've said. You need the confirmation. You guys can enter blindly when it reaches this zone, but it's not something I personally do, and it's not something I suggest. I know people that do get into the zone, right, and put their stop loss at the end of the zone. And as you guys can see, this zone would have worked. I mean, it just all depends on your risk tolerance. This zone would have worked, right? Let's go back. If you were to place an order, let's say on this 1 hour demand, first time we touch the demand, you get in a position, you put your stop. Let me just erase this right here. So we have this 1 hour demand. First time we enter this demand again, you get your entry right here, right? Let's say you had an order just sitting out there when Tesla reaches this 234.50 level. We had an order sitting there, we automatically get filled. Our stop loss is just sitting here. This trade would have worked if maybe we had a sell order right there and our stop loss down here. This trade would have worked. This trade would have been valid. It's not something I do. It's something I do plan on doing in the future. I just need to tweak some things with this strategy for my personal trading. But if you were to put an order at the start of the box, put your stop loss at the bottom, and have a sell order somewhere to take profit, this trade would have worked. And a majority of the trades would have worked, right? Netflix obviously would have been a loser because entry would have been here. Stop loss, we would have got stopped out. And automatically, right after we get stopped out, look what happens to price. It comes back up, right? So this would have worked here as well on this ES 2 hour supply. You could have got an entry here, stop loss here, and maybe take profit somewhere in this area, right? I just like actively monitoring the zones. I like seeing a rejection. I like seeing the bounce. It just helps me with my confirmation. So if you guys have any questions about this, feel free to message me in the chat room. I will be here for you guys. All right, so I wanted to add this video to the course to illustrate to you guys when to not enter a zone and when you should properly enter the zones. So this first example I'm going to show you, I'm going to chart out these zones, some 1 hour zones, and I'm going to show you how you shouldn't trade these zones just because we are in a specific supply or demand zone. So right here, right off the bat, we're looking at a 1 hour chart. We have a solid rally base drop right here. So this constitutes as a valid 1 hour zone right here. Mark that, and we will change this to pink. And what I do is I change my transparency to 75 so you could see the candles behind it. So I'm gonna duplicate this, and I'm gonna drag this down to this supply zone, which we have right here. So we have a drop, base, drop. So this is also a valid 1 hour supply zone. Now notice this is a used zone. So price dropped, based, dropped, and when price re-entered this drop, base, drop, we rejected and sold off following that in the overnight session. But now price looks like in the right before the open, we're coming back and we're going to test this zone. So I was looking to short this zone as the morning went on. So I'm going to zoom out of this. Now we're going to go to a smaller time frame chart because I like trading and taking my entries based off of a 5-minute or a 15-minute to play it safer. 5-minute is a little more riskier than a 15-minute, but I use a 5-minute and a 15-minute to find bearish confirmation. Now that's important. I only enter a supply zone if I get a bearish confirmation on a 5-minute or a 15-minute chart. And anything that constitutes as bearish confirmation is anything such as a lower high, possibly a doji, an upper wick, or even a chart pattern that formed in a supply zone, which shows the bears or the sellers or the supply is in control. And we could take that trade and put our stop loss at the high of that zone and put our take profit zone at the next demand zone that we have below. So if I was looking to enter on a 5-minute chart, price came into this 1 hour zone that we have here. I'll maximize this. So this is the same 1 hour chart. This is 8:30 in the morning. Price rallied pretty strongly into this zone. So even though price is inside this zone, I'm not looking to short yet because I have no bearish confirmation. I have no bearish signal yet. So we can keep going and look what happens. Price rips right through the supply. So there's not one candle in this zone that told me that the bears are in control. This was a straight shot right through the supply zone. So this is an invalid trade and we would not take this short even though we are in supply. We will only take our supply shorts once we get that bearish confirmation, and vice versa for a demand zone. We get in a demand zone once price comes down, re-enters that zone, and we get bullish confirmation such as a higher low, such as a lower wick, such as a bullish chart pattern possibly in that demand zone. So I would have not taken this short. You guys shouldn't blindly enter in a supply or demand zone just because price is in that zone. You have to wait for that confirmation, like I said. So if you guys would have waited for the next supply zone to hit, you guys would have seen that we did not reject this either on a 5-minute. We came up, we actually formed another demand zone. So we rallied, we based with this candle right here where my cursor is, and then we rallied again. So we did not have a clean rejection from this area. So this also would not be a good trade because even the next candle above that, we had another rally base rally. We had another demand zone down here. So this would not be a valid short at the supply zone because we never got that confirmation. We came up and we retested that supply zone. So this is also another key point is that old supply will become new demand if we use that supply as a support level. So we had this 1 hour supply down here. Price blew right past it. Did not sell off from this zone. Did not slow down, and it did not step in with sellers. Came up, and look what happened. We came back down and retested the zone. So when I see this, I can look to enter maybe in this candle right here, and put my stop loss now even down here below this low for a really low risk type of trade because old supply becomes new demand once we're above it and we test that level and it proves to hold that level. So you could flip it into the reverse side if we do blow right past that zone because obviously in the supply zone before when price blew right past it, the demand exceeded supply and the supply did not exceed the demand as you would expect because price is in a supply zone. So retests are key. Same thing with this one. We blew right past this supply zone. We formed, let me get my circle here. We formed one demand zone. Remove this. Formed two demand zones, right? Did not reject the supply. Did not make a lower high. Did not have any bearish chart pattern here. Came up. Look what happens. We come back down. Retested the supply zone. It acted as demand. And then we came up and made another rally to the upside. Not that good of a rally, obviously, because I'm not looking to go full size once supply becomes demand. It's just something to maybe scalp really fast or for a quick potential couple points to the upside. So this is when to not trade a supply zone or even a demand zone if you want to flip it. You have to wait for confirmation, and that confirmation is key. So I'm going to fast forward to when you should be trading these zones. Let's go to March 31st. This is an updated video to the course. I added this because I have a lot of questions in the chat room. When should I enter these zones? Where should I put my stop losses, etc., etc. So actually, if you guys look over here, I'll illustrate this really fast. We had a nice demand zone which bounced. So I'm going to remove this box. Remove this box, remove this box. Right here, we had a nice 4-hour chart demand zone. So we had a drop, a base, a rally. This constitutes this red candle right here. You draw from the top of the body to the lower point of the wick, extend it over, and we trade once price re-enters that zone. So now we have a 4-hour chart and a 4-hour demand zone. So I'll go into a smaller time frame. Now, if it's a 4-hour or a daily chart, I'm not going to use a 5-minute chart. I'm not even going to use a 15-minute chart. If I really want strong confirmation, I'm going to wait for a 30-minute chart to set up. And as you guys could see, we opened Sunday night. This is the futures market. So we opened Sunday night in this demand zone, and we had a nice rally. We based out, and then we rallied even some more. So this constitutes as a nice proper long play. And you could have took this long play to a decent amount to the upside. But anyway, here is a 2-hour supply zone that I want to show you when you should trade these zones. So we have a nice clean 2-hour zone. We have a rally. We have a base, and we look for that base and candle right here, followed by the drop. And we have a nice, try to zoom in here. We have a nice supply candle which formed here. So if you were to look on a 2-hour chart, you would not get a bearish confirmation really, because we came up, we have an upper wick and an upper wick. But by the time you would buy this supply zone or short this supply zone, price would have came all the way down. You would have lost a good portion of that move. So that's why I go into smaller time frames, because if you kept it at this time frame, look what happened to price. If you waited for a bearish candle, you would have bought it all the way down here, when if you went to a smaller time frame such as a 15-minute or even a 5-minute, you would have seen a nice rejection from this point. So here's the same 2-hour supply zone. We came up, and look at this. Let's say we only know this so far. This constitutes as a proper supply zone. Price came up, we rejected the zone. We made lower highs, and price is not coming up and trying to attempt to move higher. We rejected the supply zone, right? So what you can do is you're going to get long somewhere in this area right here. It depends on your risk. And what I do is I put my stop loss above the supply zone if it's a tight, small zone, because that's when, if the price does come above that level, that's when I know I'm going to be wrong, and my risk is so tight that I'm comfortable leaving it right there. So if you guys waited, you go to took the short, maybe you didn't take profit down here and you waited to a formal demand zone, which probably was down here. Even if you waited and stuck to your plan, which you kept your stop loss above this level, price, yeah, it did come back up, but it never broke this high, and it never, especially, now this depends on your risk, like I said, because some people might have their stop loss above this high, and some people might have their stop loss, like me, above the supply zone. So even though we rallied up the second leg up, we never broke this high, number one, and number two, we never broke this other high of the top of the supply zone, and number three, look what happens. A bearish confirmation, a double top inside a supply zone. That should be double conviction. You have a double top, which obviously is a bearish chart pattern, inside a supply zone, which is another bearish indicator, I guess you could say. So we have two major indicators that are leading this to the short side, and this is somewhere maybe I would add to my position once we got this double top, or yeah, I would probably add to my position here. Or if I held this, sold it here, I would look to maybe start a new position over here if we closed out our previous position. But then look what happens after this double top. We came down and price completely tanked, and we bounced, at this 5-minute demand zone. But it didn't really last that long, because obviously it's a 5-minute demand zone, and the stronger zones form on larger time frames. So this is where you should have taken this trade. You should have taken it when we got this first rejection, number one. Or number two, you could increase your position size when we double topped here. So that's when you should enter. We had that clean bearish confirmation. Even on a 15-minute chart, you would have seen that. You would have had the supply zone. We have a top, another top, and a nice move down. Let me see if I can find another example of when you should trade. So this looks like supply right here. Let me go to a 1-hour chart. Okay, perfect. So we had a nice rally, base right here, drop, right? So now what we do is we wait for price to re-enter the supply zone. It constitutes as a supply zone because we had a rally, a base, and a drop. So let me click this, show name, do not show. And then we could draw our rectangle right here. Like I said, we make it pink. I go to more, I change the transparency to 75 so we could see behind the candle. So now what we do is go into a smaller time frame. You go into a 30-minute, you're not going to see a clear rejection, because if you were to take this large candle down, you're going to miss a big portion of this move. You're not going to have a lot of meat on the bone if you take short down here. Because we looked at a larger time frame, you're going to miss a huge portion of that move. If we stayed on that 1 hour chart, you wouldn't see no rejection other than price coming down here, right? But if we go to a 15-minute, we had a nice wick and we had a nice drop. Yeah, if you waited for this next candle to close, you would have missed a decent portion of the move. That's why I go into an even smaller time frame, such as a 5-minute. So if you went to a 5-minute, we have the same 1 hour zone. Price rallied strong into an area of supply where there are unfilled orders. We had a nice doji candle. Right there, that doji triggers my supply zone. It triggers my short entry. This is where I'm going to be entering short. Once we get this doji close and the next candle opens and we start selling off a little bit, I'll hop in short right here. Direction to the left. Hop in short right here. Now this also, like I said, depends on your risk tolerance. You could put your stop loss above this doji candle, or you could put your stop loss at the top of the supply zone. And price came down the last half hour of trading and we absolutely tanked. Now we only caught this move is because we looked on a smaller time frame. If you looked on a larger one, you would have not seen that as clear as you would have. So that's exactly what I look for when I'm entering my zones. I look for bearish confirmation or bullish confirmation. Same thing goes with each zone. Supply, I'm looking for bearish. Demand, I'm obviously looking for bullish because I'm looking to enter calls in on a demand zone. So you have to wait for confirmation. Once you get that confirmation, then you could take the trade. Do not just hop in a short or a long position just because we're in a supply or demand zone, because sometimes they break right through. Sometimes they might not be clear zones. Sometimes we might even draw zones which don't constitute as proper supply or demand zones. So it's important for us to see a reaction from either buyers or sellers at these zones. You want to see what market participants are interested at these areas. You shouldn't be buying in a demand zone when it's selling off hard in there and there's no confirmation of the bulls stepping in. And you shouldn't be selling in a supply zone when the bulls are stepping in and demand is strong in that supply zone. So you have to wait for the market participants to react in that zone, and when they react, then you could take the trade. Some people might be interested in not buying or selling in a zone. So that's why you have to wait for the larger people, the smart money, and the people that are bringing the stock up or bringing the stock down. You have to wait to see if they're interested buying or selling in your respective supply or demand zone. So I hope that video helped. I'm going to try to post some more live examples in the next couple videos in the course.